Hello traders, the title of the video is "In Your Way Trader touches upon no bulls and bears a principle." So you may be wondering, George, what do you mean by no bulls and bears principle? All right, the market principle of no bulls and bears is about if I put it to you in a nutshell, is that all market participants are equal and they are all bullish and bearish. There is no market participant that is purely bullish or purely bearish. Now, this is difficult for a lot of traders to accept, but this is the reality of the market principle of no bulls and bears. All market participants are equal. They are equally bullish and they are equally bearish. You will never see a market participant that is completely, bullish and completely bearish. Now, this discussion, we can continue this discussion for hours, disagree with each other, but allow me to explain this market principle to you today. All right. So you see here, I counted 5 Elliott waves. So first wave, feel free to disagree with my wave count. Second wave, third wave, fourth wave, and the fifth wave. Now we have a flat correction that is developing. It's not completed yet. Will it continue all the way here? Will it stop here? The flat correction is a shallow correction. We have two types of flat correction. In fact, we have a classic flat correction, expanded flat correction, and a regular flat correction. They are flat. Shouldn't be deep in the proper sense of the word, deep correction. All right, that's why they use the word flat. Okay, but now the point we are talking about, Elliott wave trader touches upon no bulls and bear principle. In a nutshell, my friend, the first leg. So I'm speaking to Elliott wave traders. Are you Elliott wave traders? All right. Okay. So previously, I recorded a video about, I explained to traders about the principle of no bulls, no bear principle. That video, it's not yet posted yet, as I'm speaking to you today. It's now 9 minutes past midnight on the 12th of July. So I'm recording this video a bit late now, all right? So it will be posted either at the George Rio channel or 24 Stock Trader YouTube channel. So check out, I will be posting that video about the no bulls and bear principle. The point I'm making to you is that as an Elliott wave trader, the first leg of each of any corrective wave is created by the dominant force of the prior impulse wave. So suppose you have a zigzag pattern, we have an ABC, a zigzag pattern is ABC. Alright? So that's a zigzag, isn't it? Okay? So now before that, we usually have a multi-wave or an impulse wave. So if you are an uptrend, the dominant force is bullish. This first leg of the zigzag pattern is created by the who? Not the bearish traders, but the bullish traders. So that's what I'm saying to you, no bull, no bear. So as the market count down, like these people say, who the hell? Are we allowed to use that word? My apologies to some traders who allow these people to sell in the market like this. But now, these are crazy bearish. No, and no. These are, so when I'm saying it's created by the bullish traders, I'm saying roughly 70% of this price move is created by the bullish traders themselves. Maybe only 30% of bearish traders participate in this price down. So can we accept that? So first leg of any corrective wave is created by the market participants that have created the prior impulse wave or multi-wave. So 70% of this price move, yes, we can blame completely the bearish traders. We may say there are gigantic bearish traders that were part of it, but yet they may only represent 30% of this price move, and 70% of this first leg is created by the bullish traders. If you were in a downtrend, the first leg of that zigzag pattern will be created by who? So suppose we were here in the downtrend. So then the price bounce after this is about to create a zigzag pattern. That's the first leg. That's the second leg. That's the third leg. 70% of this bullish. Can you believe that? So market went up 300 pips. Everybody's happy. Say Dow Jones bounced up after the bearish season. The bulls are back. No. If it's the first leg of... by the way, feel free to disagree with this principle. Feel free to bang the table. Feel free to hit your computer. But think of it for a second. We may disagree here. But think of it for a while, okay? And I'm still recording this video now, so it took me some time to come to this conclusion about the market principle of no bulls, no bear. So price bounce after that, everybody's so happy. The market is going up, but 70% of this bullish move, which means the first leg, I'm choosing my word carefully. Don't say that every bullish move is created by the bearish traders. No. If it is a corrective wave, the first leg of the corrective wave is created by the prior market participant that have created the prior trend or the impulse wave or the motive wave. That's what I'm saying. So the bearish trader created a bearish trend. So now a correction has started. Okay? But the first leg of that correction is created by, okay, so this here is bullish, but the bearish trader has created a bullish price action. Okay, so the same thing if you have a flat correction, the A manner wave of the flat correction after a bullish trend, okay, which is a bearish move like this one here. 70% of this price move is created by who? Bullish traders, not bearish traders. Because only few traders, bearish traders, knew that the price would turn around here. Only few, maybe 30% of them know that it will turn around here. All right. Now, as it starts coming down, who was trading before? Bullish traders. They have to close their bullish trade. How a bullish trader close a bullish trade? They have to sell. So you say, bullish trader can sell. Yes, the bullish trader can sell when he or she is about to close a bullish trade. And they are selling like mad here. They are all coming out of their trade, selling. But they say, the market is sold off today. Who sold it? It's not the bearish traders. It's the bullish traders. Everybody look at it and say, no, I have to grab my profit now. I need to close my trade. Everybody coming out. Now people start pointing fingers on the bearish trader that they are crashing. No. So remember that the first leg, okay, whether it's a zigzag, a flat correction, or a triangle, all right? The first leg of the corrective wave is created by the market participants that were in the trade, the prior trend or impulse wave before. So same thing here, like you were here. So it went up. Now a correction has begun here. You can understand that 70% of this price move is not created by the bearish trader, it's created by the bullish trader themselves. 30% maybe by the bearish traders. So, because the bearish trader, they need a bounce up. So, this is what I'm trying to explain to you. People, before they will sell, okay, they need to, the professional bearish trader sell after a price goes down, like that's what they will sell here. They will sell here. So first leg that is bounced out. Now you can assure me, you can say that here there will be 70% of this price move. The last part of the portion will be the last portion or the last segment or the last lap of that pattern will be created by the bearish trader in this case, and here it will be created by the bullish traders. All right, but the first leg of any corrective wave is created by those who participate by the prior impulse wave, motive wave, or trending first. All right, but you need to be very careful. Suppose we have a trending first and we have a WSY wave. Now, don't go around telling people that that W is created by the by the bullish traders. No, because the W can be a zigzag, a W can be a flat correction, so it takes a long time for that W to be completed. But the first leg, the only thing that you can say when you have a W XYY, the first leg of that W, okay, will be created by those who participate in the prior trend. So a bearish traders can create a bullish price move, and everybody's so happy to say, oh, the bulls are back. Oh, yes, they kick the ass of. Okay, now, it's late now. Am I getting too excited? Some traders don't like people using words like that. Now, all right. If you get offended with that, my apology, okay? So they have kick out. So we use the word kick out, okay? The bearish trader. No, the bearish trader, because a trader now the reason why I'm very careful about the word that I use in my word is because one time a trader told me that he's watching the video with his daughter. So some people watch video like this with their family, so I don't want to exclude them, all right? So you may say, Joe, oh, you don't be the purest person on this earth. Now, so that's why I'm very careful about the word that I use in the videos, all right? And also for the advertising, okay? Okay, let's keep it very, very clean, all right? So they kick out, or they kick out they will say bullish trader, kick out the bearish trader. No, bearish trader, okay? 30% of this price move, all right, was created by, okay, bullish traders, and 70% of it was created by the bearish traders that were coming out of that trend. The opposite is also true if the prior trend was bullish. But you need to remember all the time that we are talking about the first leg. If you are dealing with a WXY wave, understand that it's the first leg of the W, so complex waves, all right? So we can, from that deduction, talking about no bulls and bear principles, you have to understand that the bearish traders are also buying. How do they buy? The bearish trader will buy when he or she is about to close a bearish position. So you see price going down, you see the bounce up that we are talking about. So here it is. So price goes down. Well, sometimes the bounce up that we see like this is not a bullish trader that is buying. Sometimes it's just the bearish trader themselves coming out. So people take, so you have to understand, this professional will take 5 positions. They may take 10 positions for one stock. So they may sell here, say 10 positions at the same time, or 5 positions. So you go down, there's a target. Okay? So they may decide to close 3 of those trades straight away and let 2 of those continue. So as they close a bearish trend, they are buying. So price bounce up a bit, but they don't want it to bounce up too much, all right? Because if it bounces up too much, it may close the other trade, and it may also alert or invite the bullish traders. So they are, so it goes down, so they secure some gain, they grab some profit gently, because if they don't want to close all position, if everybody, suppose you were here, bearish traders sold it down, and all of them close the trade here, you see a huge bounce up, even up to the 70% Fibonacci retracement level. That's why we have the Gartley pattern. You see? But then gently they close some of the trade, or they move their stop loss. That's why they don't like to close the trade. They move their stop loss to secure the gain, to put more pressure on the bearish traders, and then they may allow a bit of a bounce, and then they sell again. Well, now you understand what's going on. Okay? But the reaction, this kind of reaction of a rally up in a downtrend, 70% of that price move is created by the bearish traders in a downtrend. And the pullback that we see in an uptrend, you see those bearish move down. We see, oh, the market was going down, now it goes down for 3 months. Somebody's trying to spoil the bullish trend. No. If you look carefully, very often at the end of a quarterly candlestick bar, position trader may grab some position, may grab some profit. All right, so you check exactly where the pullback is happening. Sometimes at the end of the month, or at the end of a quarter, or at the end of a year, there are decisions are made, or because of some economy news. So people say, "Oh, bearish traders sold it down here." No, 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 no. If bearish traders are back, how do you know that the bearish traders are back? All right, because people are afraid of the bearish. If the bearish traders are truly back, all right, what do we see? Lower lows, lower high. It did not form a new lower low. It's just a pullback. So those selling activity, though, all right, we may say bearish traders, in theory, practically speaking, 70% of those activities are created by the bullish traders themselves. Okay? So this is the principle of no bulls and no bears. Right? And it's happening all the time. And sometimes there are different levels when people are selling. So you may see that if I refer to long-term investors or those who buy and hold, those who are not technical traders. So they bought it went up, yes or no? Okay. It's like the Bitcoin traders. Okay, everybody was buying Bitcoin. Bitcoin has completed a multi-way. So people see the first reaction down. Okay, 30% of the first leg of the correction for the Bitcoin was created by who? The bearish traders. 70% of that was created by the smartest Bitcoin bullish traders. They see it, they say, "Oh, I need to grab my profit." So they created the first leg. Now we see this bounce up. Now this bounce up, all right, this bounce up, okay, either there is no more demand to sell. So if there's no more demand to sell, the price will bounce up. Or it's just the reaction of the bearish trader that joined this first leg coming out of their trade. You see, but the problem that we are facing is that sometimes market participants that are buying and hold, ordinary traders who do not understand chart pattern in their way of Fibonacci, as it's going up like this, they come back again and buy. So they buy, they're buying. Sometimes that's why you see some patterns are distorted. They buy. They think that it's going to go up more, but no, it's a correction first. Right? And those people sometimes, they are forced to sell lately. Though, that's why I say to you, usually, the last leg of a corrective wave, all right, you'll notice that 70% of the activity here is controlled by the bearish traders because it's down move, okay? And 30% of it will be bullish traders that are late to sell. So they are hanging on to their position, and now they say, "Well, I'm giving up on this stock now. We bought it here, now here it is coming down." As it's coming back to where they bought it here, they're coming out. So 30% of the last leg of corrective way, you will notice that it's the activity of those who created the prior impulse wave. They are late, they are ordinary traders. I don't want to call them dumb money. They are ordinary market participants who are not aware of technical trading, and they are coming on late, and the bearish traders control the price. So this move, 70% of the activity here is controlled by those who created the trend. They are smart, they are not stupid. They see it's coming down, they say, "No, I'm coming down now." Okay, now we see this bounce up. So bounce up can also do to no demand to sell, or bullish traders coming back, or dump money, buying, taking that, the trend will continue. So the B wave or the flat correction, or usually the second segment of a corrective wave, usually you see a lot of retail traders, ordinary traders, or what they call generally dump money, because if you were an Elliott trader, you see like this, what's going through your mind here? You say, correction has started. The common setting has broken. Now, we may have a flat correction, we may have a zigzag, we may have a WSY wave, we may have a complex wave, we may have a triangle. It's going through your mind. So you won't be too excited to buy here. You go into technical trading mode here. Careful. You won't buy and hold in this situation. Even if you do, you will be you will keep your eyes on it. We're checking it every day, yes or no. All right. But sometimes most of the ordinary people who do not understand the market principle will join the B wave of the corrective phase. All right. So yeah, again, and then it was solid. So in a nutshell, okay, talking about in your wave trader touches upon no bulls and bear principle. This is it. No market participant is purely bullish or bearish. That's it. A bearish trader will sell. A bearish trader will sell normally. But don't forget, bearish traders do buy when they are about to close the bearish trade. Same thing, bullish traders do sell when they are about to close a bullish trade. And usually, 70% of the selling activity that we see during the first leg of a corrective wave after a bullish trend is the activity of the bullish traders that are busy selling. Can you believe that? And 70% of the activity that we see during the first leg of a corrective wave after a bearish trend is the activity of the bearish traders. Bearish traders are busy buying. Why? Because they are closing their bearish position. So don't go around blaming, the bearish traders, all right, or the bullish traders. Now you understand why we see those bounce up, especially in an uptrend. There it is. So this is it. If you have any question or suggestion, feel free to put in the comment section. And because I will be recording another video to answer your specific question. If this video has been truly useful to you, please let us know by giving us the thumbs up. If you dislike it, or be sure to mark it down. If you think it's an essential tutorial, feel free to share it on the social media. Be sure to subscribe to our channel today. Our channel is 24 Elliott Waves, digit 2, digit 4, Elliott Wave in plural. Click on the notification bell so anytime we record a new video, you will be the first person to be notified. Until next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about Elliott Wave trader touches upon no bulls and bear principle. If you want to learn more about market principle trading, check out our YouTube channel, George Trio, and also 24 Stock Trader YouTube channel. Subscribe to those channels. I'm now starting to record series of video about the market principle. So that this is just to talk to Elliott Wave traders about no bulls and bear principle from the viewpoint of Elliott Wave trading. Happy to lead to you all, and I will speak to you soon. Thank you for watching.